Hi, I'm Saidel-Baker. I'm an economist at ITR Economics, and I'm here today to talk to you about capital investment. Now, the most important thing to realize about capital investment is that it needs to be intentional. You need to have a plan for your capital strategy. And fundamentally, there is a right time and a wrong time for capital investment. The best way to know the right time and the wrong time is to be calculating your own rates of change. Once you know where your business is in the business cycle, once you know where your sector is or where your market is in the business cycle, you can know if now is the time to be pulling the trigger on those capital investments. It seems a bit counterintuitive, but the best time for an investment is actually during the trough of the business cycle, when we're at that low point between phase D, recession, and just about to turn up into phase A, the recovery phase. At that point, it might feel counterintuitive to be investing. Things are bad. We're down from last year. The whole economy is probably feeling pretty dour. But that is the time when you need to be acting. First of all, you'll probably get the best valuations during the trough of the cycle. Everyone else is feeling that negativity as well, so they're probably cutting prices. There's probably more availability and maybe not the demand. Secondly, if you do that investment during the low point, you'll be ready. You'll have the equipment in place, the people in place, whatever capacity it is that you're bringing on, you'll have it in place for the rise. That's the most important thing. You want to be riding that rising trend, not responding to it. Naturally, many businesses do want to be investing during the upside of the cycle, say phase B, our accelerating growth phase. That's the time when things feel good. Sales are up from last year and growing at an increasing pace. It's very natural to feel capacity constraints, to have demand pouring in, those orders that you can't fill today, to see those lead times extending and say, this is when I need to be doing my investment. But that's not the case. First of all, you're probably paying a higher price for whatever it is you're investing in, but additionally, think of the lead time. It takes a while for a lot of this capacity to be put in place. The risk, if you invest during phase B, is that just when you get that capacity, when you get that investment implemented, ready to go, well, that could be the peak of the cycle. And you might have all of this additional capacity just at the time that demand is pulling back. So don't overinvest. Invest at the right time. It's all about knowing your rates of change, and it's all about acting on it once you see those leading indicators coming into play. We at ITR always say to follow your rates of change to know where you are in the business cycle, and there's no better reason than for planning your capital investment.